Hello everyone, welcome back to my channel. So in today's video we are going to dive into one of the most crucial concepts in options trading and especially when it comes to the wheel strategy, which is the implied volatility, and it's also called the IV, and why also this is so important to understand how it works, the concept itself and its various applications as you try to deploy the wheel strategy. It doesn't really matter the level of proficiency with options in which you're at. You can be a beginner, you can be a professional, and implied volatility is an important concept at every stage of your development as an options trader. I wanted, just to make a brief side note, I wanted to make this video for quite some time, but yeah, basically because of work commitments and other stuff, I was not able to do it, but now finally I found the time in my schedule to do it, and so yeah, this is something that I really wanted to complement our Road to 200k challenge that has been going on for a while. And yeah, basically this, by understanding this concept, this will make a huge difference in the way that you place your trades, and eventually it will make also a big difference in your performance and your profits, which is the most important. And so without further ado, yeah, let's get into it. So basically I think first and foremost we need to start by understanding what is implied volatility and what the concept means. And so basically implied volatility, it measures the market's expectation of how much a stock will move over a certain period. As you know, and I already mentioned before many times, options, when you trade options, you are basically placing a bet on volatility. If you believe that volatility is going to be high, you usually buy options, because by doing so you will be accounting for the increase in volatility, and so you will be able to profit from it, or at least to have a lower loss. Just to give you a brief explanation, if I open here the paint, for example, and just to quickly explain here, this is a profile, the profit profile of a call option, all right, of a long position in a call option, and this is the profile of a long position in a put option. And so as you can see, assuming this axis is the profit, all right, this is the profit, and so if and of course this is the price, all right, price, and so if the price is very volatile, all right, what's going to happen is that if the stock moves to this side, you will profit because you will exercise the call, and so you will acquire the stock with a higher price, which is trading at a higher price than the one you will buy, which is basically here your strike price, all right, your strike. And in the same way, if you have a long position in a call option, and the price ends up around here, your loss is limited because it can't go below the premium that you paid, and so the option expires worthless. You don't exercise it, and so you have a much smaller loss than you would if you hold the option yourself. And the same reasoning, but in the opposite way, goes for a long position in a put option. If the price is very volatile and it ends up here at maturity, you'll profit because the price is much lower than your strike, all right? The strike, sorry, this is not correct, but the strike price is here, right? When this inflection point, right? And so what's happened is that you will be able to sell stock trading at this price, which and you sell it at this price, and so you have a much significant gain, because you basically selling at a higher price and the stock is being traded at the moment. And on the other hand, if the price ends up in here, you will not exercise the option. You will have only a small loss, which is basically the premium that you paid, which is this loss right here. And so this is something that this is a position that allows you to profit from high volatility. On the same page, if you use a short position in both a call and a put, all right? This was an horrendous line, but no, just pretend that this is perfectly drawn. And so this is a short position in a call, all right? And this is a short position in a put, all right? And so what's happening is that if the stock is very volatile, what can happen is that if as the price moves a lot, right? If it stops here, you will in all likelihood have a loss, because you will selling a much more valuable stock at a lower price, which is a strike, right? And if it falls in here, the option expire worthless. It does not get exercised by the buyer. You simply pocket the premium and that's it. But the upside is very small compared to the loss that you can potentially have. And the same thing for the short put. If the price moves around a lot because it has high volatility, it can end up right here and you have a large loss, because you will be forced to buy a much devalued stock at a much higher price, which is a strike. And if the stock ends up right here, you don't get much upside apart from the premium that you already received. So by having a short position on a call or on options, you are betting on low volatility, all right? And so this is something which is extremely important, all right? And so because the implied volatility can measure the expectation of the stock movement over time, and so based on the implied volatility and what the market perceives, you can assume long positions or short positions on options. Of course, when you are trading the wheel, you only sell options, and so you are basically always profiting when volatility is much lower. So you need to be much more careful when you trade the wheel when at a time in which implied volatility is high, because as you can see, high volatility, market expects big moves, either up or down, which is not the optimal situation in a market for the wheel. But in a low IV, when low volatility is low, implied volatility is low, markets expect smaller moves, and so it's more likely that options will expire worthless, and so you will pocket the premium, and that's it, and you move on. And so you can think of the implied volatility as a measure of fear. When fear is high, implied volatility is high because something is coming. For example, earnings release, there's a lot of uncertainty about what of the earnings of which are a measure of performance of the given company, and so implied volatility tends to go up when the market is nervous, for example. And when things are calm, there are no volatility events such as earning releases or announcements to be made. The implied volatility drops, and so this is an environment which is much more likely for the wheel to be a successful strategy. And because, as we already spoken in the previous video, this state of the market is where the market is for a very, very large percentage of the time, and only in very rare occasions this goes very high. All right, and so that's why also one of the reasons why the wheel is a very successful strategy. But of course, as you can imagine, when implied volatility is high, what's going to happen is that you will also profit more. And why is that? Because the wheel strategy involves selling both cash covered puts, and you sell them over and over again until you get assigned, all right, the stocks. You are forced to buy the stocks, and then when you have the stocks, use them as collateral to sell covered calls. All right, and so because the wheel involves selling either puts or calls, when implied volatility is high and there is more fear in the market, the markets and investors don't know what's going to happen, the premiums are also going to be higher. And so if you know how to trade well the wheel, you will take advantage of this market environment to sell options and collect higher premiums. And so this is a particular moment in time in which you can bump up your returns on your strategy by selling options on stocks which are not that volatile, but because implied volatility is high, there's a lot of fear in the market because of a specific earnings announcement, you take advantage of it and earn more premiums. Because the higher is the premium, because of the high implied volatility, you also increase your income by taking on the same risk. Just to give you a brief example, if we go here to a broker, I use Interactive Brokers, but you can use any other. For example, you can use any particular stock in the market. Let's try, for example, I think Polaris is a good example. Let's see here. If you go here, this is a stock which is quite good. As you can see right here, it's undervalued at this moment. It has a wide economic moat. The moat is stable. It has a minimum certainty. It's good. But as you can see right here, historic volatility, which is the volatility that the stock had over the past year, was 26%, but now the implied volatility is 46%, so it's 20 percentage points higher. And why is that? Because on October 22nd, so a few days from now, at the time this video is being recorded, Polaris will release its earnings, and there is a certain expectation. In here it says 88 cents per share, and that is why, as a result of this, implied volatility is higher, and so the premiums that are being practiced, of course at this time the market is closed because we are doing this on a weekend, but nonetheless this is market data from the past business day, the past trading day, and so these premiums for the puts and for the calls are inflated based on relative to what would otherwise have been by historical terms, especially because volatility is high. Investors don't know if the stock is going to skyrocket because earnings were very good, or it's going to drop like a stone because earnings were bad. And so because there's a lot of uncertainty, the premiums on options are pretty much inflated. All right, and so this is the reason why. And I can give you, for example, if we put here in a calculator, let's just say, for example, here, this is a strike price that I would probably use because it has a probability of profit of around 80%. And so by using this particular option and making the expected profitability of it, we can see that, for example, even though this is not traded on a weekly basis, but we can do this anyway. So this would be because each contract has 100 shares, so this would be $65 in premium in exchange for 7,500 euros, which would be the strike in case we are forced to buy. This is the amount that we would have to come up with to buy the shares. And so now we are going to adjust for the probability, and we are going to multiply this by 365 and divide it by the 26 days. And so this, even though this is not the best example because it only gives us an amount of 10%, but we can find an old friend of ours. For example, we can find him here, the HIMS stock, for example, which is quite significant in terms of premiums. As you can see, there is also an earnings coming on November the 4th. Well, historic volatility is much lower than the current implied volatility, and so we can use this example here. So by using, or we should rather use this one because this one has a probability closer to the one that I would probably use, which is 78%. And so by having $35 in premiums received with a collateral of 2,100, all right, we adjust by the probability, and this is 5 days away. So we would use 365 divided by 5. So as you can see here, this would give a return of 95% because the volatility at this point, the implied volatility, which is reflected in these premiums, is very high. And so if this stock would not go below 21, we would have this option expiring worthless. We would keep the premium and we would have an annualized return of around 100%. So as you can see, just because volatility reflected in the premiums is quite high. And so yeah, basically this is one of the examples that I wanted to show you. For example, as I mentioned before, earnings release IV often increases, and this is done for the same level of risk. And so this is where you need to consider the IV when it comes to selling options for the wheel strategy, because you are doing this all the time, selling puts and then selling calls, selling puts, selling calls, all the time. Now, the difference between a high implied volatility and a low implied volatility, and this is something which is important to understand, is that when you sell puts, all right, when the implied volatility is high, you receive a higher premium. Of course, you have better returns as long as the stock does not drop significantly. And why I say this? Because this is important, because if you wait until and you keep selling the puts until the volatility event happens, you run the risk of your strategy backfiring, because the stock can drop significantly because, for example, the earnings were bad, and so investors simply sell off the stock and you are forced to buy the stock at a much higher price than the price that the stock ends up trading when the option reaches its maturity. So the key here is that you continue to sell the puts to get higher premiums, but you stop doing it when it comes to the time in which the earnings are released. For example, here, November the 4th, all right, and as you can see here, November the 1st is the last time the options reach the maturity before a weekly option reaches the maturity before the earnings are released. So when you are selling puts, you stop selling the puts after this week. You let the earnings being released, and then after that you can continue doing that. So basically, if you want to sell HIM's puts, you will simply stop doing it for this week, and then you'll continue down your journey again as if nothing happened. Of course, it could also happen with you could also continue your campaign with a much different strike price than the ones that you use in here, but nonetheless you avoided the volatility event altogether while still capturing the benefit of collecting larger premiums while we are leading towards the earnings release. And so this is something that is very important, because if you do this by this point, all right, these options that we were talking about expire on October 25th. So you could continue to do that. You could continue to do the same between this week and this week here on November the 1st. But when it comes to the week after the November the 1st, you stop. You don't sell more puts. You leave the stock alone. You let the earnings coming, and then you continue this campaign for the other weeks. The important thing is to avoid the volatility event altogether. All right. So this is a key to successfully trading the wheel strategy in a situation in which implied volatility is very, very high. All right. But it can also happen if you want to trade an option in which there is no volatility, or volatility is very, very low. You can come, for example, to this stock, US Bank Core. This is a stock that already released its earnings. The earnings actually were good. The stock rose a bit when the earnings were released, but at this time, as you can see, the volatility that the stock had over the past year was 29.9%, and now is 5%, actually 6 percentage points below that. So the volatility that is reflected in the calls and the puts is lower than it should have been, and that also shows in the profitability of the premiums. For example, if I use this one, and this one would be something that probably I would consider because it's close to 80%, and it's very comparable to the one that we use on HIMS, because HIMS has a probability of profit of 78%, if I'm not mistaken. And so we can pull up our trusty calculator and see how much profitability this particular option would have. And so we would receive $22 in premium with a collateral of 4,850 euros. We adjusted for the probability, all right, 77%, and this would be for 5 days, so 365 divided by 5 days, and as you can see, this would only give us an annualized profit of, or return of, 25.5%. It's a much lower return because the expected volatility in here for this particular option, and because of the stock is also past its earnings, there are no volatility events coming, and so the premiums are very low for this one. Probably I would say it's not worth taking the risk to do that, because this stock is simply it has a too low volatility to be considered, because the returns are quite low. And in that case, it's going to be better to wait for high volatility if it's coming, or look for other stocks basically to have better premiums, because most likely it's not worth the risk. There are better alternatives around. And so, as I mentioned, to reinforce this idea. The timing is really everything. And so when you sell cash covered puts, you ideally want to sell them when the expected volatility is high. All right, always trade it up until the point, or up until the date in which those volatility events come around. So be it either earnings announcements, economic data releases. And so by doing that, we avoid having the impact that it's expected to come either up or down, because as you can imagine, when you sell cash covered puts, and I show them that in here, even if the price goes strongly up, you have no upside because you already collected the premium, and from there on end, all you need is to the stock to the option to expire worthless. But it doesn't matter if it stops, for example, at this price or this price or this price. You will earn the same, and you already captured your premium. So what is most important to you is the stock ends up around this area here in terms of price, because this allows you the put to expire worthless, and there is no more commitments related to this option when it comes to you and the possibility of being forced to buy them. And on the same page, when it comes to covered calls, because you already acquired the stocks and you have the implied volatility is high, you should only sell them, of course, and it's better for you to sell them when implied volatility, of course, is high. But if the earnings or the event is coming, basically you have not so much downside, because you want to basically get rid of the stock, because you want to continue to sell more puts and get the cash back from the sale. And so make sure that you are always selling covered calls when the stock price is close or above the acquisition price, because if it's too far below, the premium is going to be almost irrelevant anyway, or the short positions on the call may not be available. And always as well, make sure that your strike price is always at or above the acquisition price, because you don't want to realize capital losses when turning the wheel and selling the covered calls. And as I mentioned, higher premiums mean better income potential, but also have more risk of price movements, as we already spoke about it. And so when it comes to the risk related to this strategy, of course, we know that even if the stocks are two stocks are the same, higher premiums usually I said it wrong. For options with the same implied and or historical volatility, the higher the premium, the higher the risk. All right, that's why, for example, in the one that I explained before, HIMS will always have higher premiums, offer higher premiums than a US bank core, because the historical volatility on HIMS is 76%, and the implied volatility on US bank core is 29.9%, give or take 30%. So you will always collect more premiums on HIMS, but also because the volatility of HIMS historically is much higher. And so by assuming or by taking on more risk, you are rewarded with more premiums. Otherwise, it wouldn't make sense to sell options on HIMS. And so you need to manage risk. All right, this is absolutely important. It's absolutely critical. And so it's better for you if you sell options just as I do, with a short expiration date. I usually trade only weekly options. and always stop and when the volatility event comes, because it's important for you not to be exposed to the stock when the volatility event happens. This is extremely key. Yeah, of course, this is something that it's a no-brainer. Is something that is on every investment book or every investment mandate. Of course, it's always better to diversify your trades across multiple stocks with high IV, of course, to spread out the risk, because by doing so, even if you get assigned the stock because the price just came crashing down, it's much better for you to have a small position, and it's going to be much more easier to manage that assignment when it comes then to sell covered calls, than having a large position being assigned and then your money are tied up into a large holding, then you need to basically get rid of the stock and a large amount of stock to get your money back. And so how long it will take you to do that, we don't know. So it's always better to have smaller positions, and because of the risk diversification, and also to keep your options open, your powder dry, to continue to sell more puts using the cash you have as a collateral. And so one of the things that you can do, for example, and this is something that I already did when it comes to the stock selection for the options, you can use, for example, the current implied volatility relative to the historical implied volatility. Here, probably I mentioned it wrong. It should not be the historical implied volatility. You can do it on the historical volatility, all right? And so we can simply do this, all right? And so by doing this, and you can, for example, consider the fact that there are several tools for you to do this. For example, if I go here to the market screener, you can add a filter, which is a very good one for this, which is this one. And then you have the ratio between the implied volatility and the historical volatility. Because by doing so, you will be comparing apples to apples. You cannot compare an historical volatility of a stock which is a low, all right, compared to implied volatility of a stock which is by nature much more volatile, all right. And so to come back on the examples that I gave, for example, if you use the HIM stock as an example, if you see here, and if the implied volatility of HIMs is, for example, 50%, let's just say 50%, it's very low implied volatility. And why is that? Because historical volatility is 76%. But if you think about the US Bancorp, for example, the same implied volatility of 50% would be extremely high. And why is that? Because the historical volatility is around 30%. So you always need to compare implied volatility of a stock with its own historical volatility, and not compare it with other stocks, because other stocks may have different levels of volatility. And so by using this indicator, all right, you can, for example, see in here, all right, and you can also filter for the US stocks and other indexes if you want. But for example, in here, you will see that by using the one that has, by sorting out this list for the ratio, the one that has, for example, the higher ratio, let's just say, for example, this one, as you can see right here, it doesn't have even a record for the historical volatility, but yeah, it has, all right. So volatility is 48%, but implied volatility is 760%. So as you can imagine, something is very wrong here. The price is the premiums of this stock, if this stock trades options, which is the case. As you can see, this would well, you can see that by this option chain that these options are rarely traded because the bid-ask spreads are so large. But nonetheless, this gives you an example that, all right, by doing so, by establishing this connection between the historical volatility and the implied volatility, by having a high ratio, implied volatility is higher than usual, and so this means that a volatility event must be coming, all right? But if the historical average, the historical average is higher than the current implied volatility, that gives us a low ratio, and the current implied volatility is below average. So that means that in principle it's more likely that short positions on options by trading the wheel are going to be expiring worthless. It's more likely, but on the same page you will receive much lower premium. So there's always a balance to be struck in here. The real life example that I wanted to show you I already did, but I can do it for example for other stocks here. We can consider, for example, Lyft. Lyft has its earnings coming here on November the 6th. As you can see, as an implied volatility of 81, which is compared to its historical volatility of around 47%. It's a big difference, all right? And so, for example, and we can see it right here, this option chain is not that deep, all right, but we can do this one. This is an option that I would consider for the wheel because it's 84% probability of expiring worthless. If we bring out our calculator and we try to calculate the expected the probability adjusted profitability that we would have, so it would be something like this, right? Let's just see, 84% and times 365 by 5. This would be not that much, a profitability of 42.4%. But if we use, for example, another stock which does not have any earnings announcement coming soon, as you can see, the Carnival company here, the probability is a bit, the historical volatility is only a bit above, all right? But as you can see here, let's try to see, right, this is 91, this is too much. Yeah, this one probably is not going to be as good as the example because the probability, the implied volatility is very close to the historical volatility, but still it's high. But let's see. Yeah, probably we can work with this. Let me see other examples. Let me see. This also has its earnings coming, but this is probably better because this volatility, even though earnings are coming, the difference is not that big, and the implied volatility on absolute terms is quite low. So let's try and see what happens in here. So this is 91. Let's see in here. This is 83%. Yeah, this is a comparable one. And so you will see that because the volatility is lower, all right. Let's try and do this. So $29, the collateral will be around 8,500. This is 0.83 times 365 by 5. So as you see here, because the Lyft stock had an implied volatility of around 80%, right? And so if my memory serves me right, lift, see, yeah, it was 81%, and so the profitability of an option with around 81 with around 82-83% of probability of profit, which was this one, 84%, was 42.4% of profit if it expired worthless, adjusted for the profit for the probability. But the other stock that I showed you, the Hilt, the Gillette Services, because its implied volatility, it's only 27. Let me see, 27. Yes, it's 27. The probability adjusted profitability or return, it's only about 20.7%. So it's a much lower return. All right, even though it also has its earnings coming, but because the historical volatility is also low, this slightly higher implied volatility, that means that investors are very confident that there's not too much risk coming from this earnings release, and so they are not inflating the options price too much, and because of that, premiums are not that high. And so probably investors are expecting or are assigning a higher probability that the lift earnings are not going to be as good, and so that is why the options premiums are higher, because they have a higher uncertainty about those earnings, and so they bump up the premiums of those options. And so this is basically one of the examples that I could show you. But just to wrap up this video, and because we are already beyond 40 minutes, and so, and as I mentioned in the beginning, the implied volatility is really a key factor when using the wheel strategy. It affects the premiums that you collect, all right, and affects also the risks that you take by trading those options, all right. And so it's very key for you to get a very deep knowledge of how implied volatility works, as I mentioned and as I showed to you. And so by doing so, you can understand, all right, when should I get into this trade or not, because timing is very important. And so, as I mentioned, you should also target the stocks. Even though they have earnings coming, you can continue to sell options on those until the earnings event comes. When that event comes, you stop, all right, especially if you are selling puts, cash covered puts. You stop, you let the event taking place, you see the direction at which the stock will go, because you have almost no upside by selling options. The upside can be big for the buyer of the options, not for the seller. And so you already collected the premium, and so there is nothing more you can earn from the option, all right? And so it's key for you to let the volatility event go, and then after the event happens, you resume normal service. You continue to sell the options, especially if you are selling the puts, and of course at that time volatility will be much lower, but for sure you will find other alternatives with better premiums according to the risk, and in order to continue to pursue the strategy. But timing the trades is key, and in order for you to try to time your trades as best as you can, understanding implied volatility is key, and by doing so you'll be able to maximize your income, because these occasions in which there are volatility events are a prime opportunity for you to get more premiums from your trades, and to compensate for the times which are the normal situation, the times in which premiums are much lower because there are no volatility events coming and the market is calm, everything is quiet, and so the consistency of the strategy allows you to do that. But when it comes to those volatility events, it's time for you to take the most advantage out of it. But for the time being, this is it. Feel free to like the video, subscribe, also to leave your comments below, any suggestions, any remarks that you may have. You can also connect with me on LinkedIn in case you have any questions and any remarks to make. You can send me a private message. And that is it, and I'll see you all in the next video.